$725 billion. That's what just 4 companies are about to spend in a single year. Amazon, Microsoft, Google, and Meta are pouring more money into concrete, steel, and silicon than the entire economic output of most countries. Let that land for a second. So here's the trillion-dollar question. Is this the smartest land grab in tech history, or the most expensive fear of missing out trade in market history? Stick around, because the answer will shape where the next decade of market gains comes from. For 2 decades, these giants were the high priests of the asset-light era. They turned elegant lines of code into mountains of cash, with almost zero physical friction. But this earnings season, something startling showed up in the numbers. Profits are growing over 20%, yet free cash flow is shrinking. Why? Because they are literally pouring concrete over the cloud. By 2026, their combined capital expenditures are projected to hit $725 billion, a staggering 77% surge in a single year. The digital elite are becoming the new utility barons. So why the spending mania? In one word, fear. Not fear of overspending, fear of underbuilding. In the AI era, compute capacity is the fundamental unit of production. If you cannot serve customers or train your next model, you do not just lose a quarter of revenue, you risk losing an entire decade of market share. CEOs have run the math. Idle servers are survivable. Being structurally short on compute is not. Listen to Satya Nadella. He admits Microsoft is, quote, capacity constrained, and that Azure is turning away AI revenue it cannot serve. Think about that. Microsoft is leaving money on the table because it physically cannot take it. And the urgency is not evenly spread. Amazon and Microsoft are each roughly doubling their spend. But Google is making the steepest climb of all, with an estimated 110% year-over-year increase, an all-out push to defend its search and cloud flanks. Run the numbers with me. Google jumps from about $85 billion to roughly $185 billion. Amazon goes from $100 billion to $200 billion. Microsoft climbs from $95 billion to about $190 billion. And Meta rises from $70 billion to around $145 billion, an 80% leap. Everyone is flooring it. But here's the catch. The market does not treat all this spending equally. Call it the monetization paradox. Amazon and Microsoft enjoy what you might call double monetization. They are not just building AI for themselves, they are renting out the shovels in this gold rush through AWS and Azure. Amazon's spending is backed by a staggering $364 billion backlog of unfulfilled cloud contracts. AWS has hit a $150 billion annual revenue run rate, with growth accelerating to 28%. Translation: for every dollar Amazon spends on a GPU, a business customer is already waiting to pay for it. Meta is the opposite story. It faces single monetization. There is no public cloud to rent out, so every infrastructure dollar must be absorbed internally to improve ad ranking. And here's a detail most investors missed. Meta's recent 20+% profit growth was flattered by an $8 billion one-time tax benefit, which masks the true cost of this build-out. No cloud backlog, no contractual safety net. That's why analysts call Meta's CapEx a blank check risk, a long-term trust leap that its cloud-native rivals simply do not have to take. Now look at this shift. 2 years ago, the bottleneck was getting your hands on NVIDIA chips. Today, it's not the silicon. It's the gigawatts. Roughly half of all current CapEx now flows into the physical plant, the data center shells, the land, and the complex liquid cooling that high-density AI racks demand. A single large-scale AI campus costs between $5 and $10 billion, and it can consume as much electricity as a mid-sized city. Let that sink in. One campus, one city. So big tech is becoming big energy. And we are not talking about solar offsets anymore. We are talking massive baseload power grabs. Amazon is leading the charge, signing nuclear power purchase agreements at a staggering scale, including 2 gigawatts of capacity for OpenAI and a massive 5 gigawatts for Anthropic. The irony is total. The most digital companies in history are now restarting decommissioned nuclear plants just to keep the lights on in the cloud. Let's zoom out for a second, because this spree is quietly rewiring their balance sheets. Here's the accounting detail most people miss: the depreciation lag. Out of that $725 billion, only $211 billion shows up as depreciation on this year's income statement. The other $514 billion sits on the balance sheet as long-term assets, waiting to be amortized over the coming years. And that creates a serious impairment risk. If the useful life of an AI GPU turns out to be 3 years instead of the 5 or 6 management assumes, the eventual write-downs could be devastating. Meanwhile, the asset-light era is officially dead. Meta just issued a record-breaking $30 billion bond offering to fund its data center build-out. Big tech is becoming a permanent fixture in the high-rated corporate debt market, drifting away from those cozy net cash positions. And check this ratio. Microsoft's CapEx to operating cash flow has already blown past 50%. That means more than half of every dollar the business generates goes straight back into hardware. So how do these giants protect their margins? They go to war with NVIDIA's 70 to 80% margins by building their own chips. Amazon has Trainium, Microsoft has Maya, Google has its TPU, Meta has MTIA. The logic is twofold. First, custom silicon can cut unit costs by 30 to 50% compared to merchant GPUs. Second, it's a lock-in play. Optimize your software for your own hardware, and developers can barely leave your cloud. This is not just cost-cutting, it's architectural lock-in, designed to turn that $725 billion bet into a permanent moat. So let's land the plane. The AI race has rewritten big tech's DNA, from software first to infrastructure first. Analysts now project combined annual CapEx will smash through $1 trillion by 2027. The companies that once bragged about having no factories and no inventory are now the most prolific builders of heavy industrial plants on Earth. When compute becomes the new global currency, success is no longer measured by the elegance of your code. It's measured by the scale of your power grid and the efficiency of your silicon. Which leaves us with the big question. Are we watching the birth of a brand new essential utility sector, or the most expensive bubble in market history? Drop your take in the comments. Are you team land grab or team bubble? I read every single one. And if this breakdown changed how you see these stocks, hit like and subscribe so you don't miss the next deep dive.